Prediction for asset values. Equity markets have several significant headwinds that should cause a meaningful market correction. The Federal Reserve will be tapering with a potential rate increase. You're starting to put less and less liquidity, and with having to service this debt, you're slowly draining money out of the system. Democrats could pass significant tax increases that will affect corporate and capital gains rates. Look, the equity markets are a discounting mechanism to discount cash flows. That's what the equity market should. A properly functioning equity market is looking at the cash flows of a company, discounting that back using some rate, and arriving at a value. Well, if you change the corporate tax rate, you get less cash flows, and if you raise capital gains rates, well, guess what? Your economic return changes. So that would have a negative impact on equities. And then lastly, year-over-year revenue and earnings comps may be negative by Q1. You're already seeing many companies having this issue. They had such a boom, depending what area they were, during the heart of COVID, that all of a sudden, like a bike maker, a big boom, and all of a sudden, okay, there's less bikes being bought, and so the year-over-year comps get more difficult. So I think the equity markets are set up for a pretty, potentially pretty good correction. Commercial real estate values will remain strong and capitalization rates low due to two factors. Other than commercial office, rental rate increases for most asset classes. Look what's happened in industrial, look what's happening in multifamily. We're having rental rate increases in all my multifamily complexes by 3 to 5%. This isn't slowing down. Industrial is skyrocketed, so even retail is starting to see that. So I think that's going to bode well for real estate. A lot of times, remember, real estate is viewed as a good hedge against inflation. And because of that, the capital flows will continue to flow into real estate. So I think the real estate, commercial real estate markets will remain strong. Housing price appreciation, on the other hand, will stall and potentially see a 5 to 10% correction. Housing has overshot its value. It's so many people can't afford it right now. And what I think will pull it back is the 30-year mortgage rates will increase modestly, but just even a modest increase will, what you can pay for a home, be changed based upon your earnings. Housing values, as I said, have become unaffordable to too many people in the public. Supply of housing will increase with foreclosure moratoriums being lifted. It's now been lifted in California. It's being lifted in New York, New Jersey, all over the country. So you're going to have more supply come on. And then lastly, seniors are going to start feeling more comfortable to having people walk through their house, look at their homes, sell their homes, and moving into assisted living or senior living. So I think you're going to have an increase in supply, increase in mortgage rates that will bring down housing. I'm not saying anything we're going to have a housing bust like we did last time. We're undersupplied with housing. I'm just saying pricing will take a knockdown. Oh, and there's another factor. There's been so much speculation going on in housing, and now some of those big speculators, the big Wall Street funds, and even individuals are starting to back off. In fact, Zillow had to announce their whole home buying flipping program was such a disaster, they just pulled out of the market. That was yesterday. Their stock's down in 2 days like 30, 35%.